Ladies and gentlemen, let me start with a simple question that should make every serious investor sit up straight. What happens when a market price starts moving faster than the system designed to control it? Today, silver has broken above $70, a level many were told would never be seen again, or at least not in our lifetime. Yet at the very same moment, more than 517 million ounces of silver are sitting inside COMEX vaults, reported, counted, and labeled as available. On paper, everything looks calm. In reality, this is the kind of calm that appears right before pressure finds a breaking point. History teaches us that markets don't warn loudly. When the structure underneath them starts to crack, they whisper, and only those paying attention hear it. For decades, silver has been treated as an industrial afterthought, a metal with endless supply and limited monetary importance. But prices do not rise like this by accident. A move above $70 is not just a technical breakout, it is a message. It tells us that demand is no longer politely knocking at the door, it is pushing. Industrial use continues to surge, investment demand is accelerating, and trust in paper promises is quietly eroding. The world is waking up to the fact that silver is not just used in electronics and solar panels. It is also a store of value that cannot be printed, paused, or politically negotiated. When confidence shifts, it does so quickly, and the price becomes the messenger. Now let's talk about those 517 million ounces in COMEX vaults, because this is where the story gets uncomfortable. In the vault does not automatically mean available. Much of this silver is already spoken for, pledged, or backing multiple claims. The futures market depends on confidence that contracts can be settled smoothly, but confidence is fragile. When enough participants decide they want the metal itself instead of cash settlement, the math changes overnight. This is how shortages don't announce themselves in advance. They appear suddenly, when too many people reach for the same door at the same time and realize it only opens for a few. This is why this moment matters. Silver breaking $70 while massive quantities remain trapped inside a system built on leverage is not a coincidence. It is a signal that the physical market and the paper market are drifting apart. And when that gap widens, it doesn't close gently, it snaps. Every major repricing in history followed this same patterns: long periods of suppression, widespread disbelief, and then a rapid adjustment that leaves latecomers shocked by how fast everything changed. The biggest risk is not volatility. The biggest risk is assuming the old rules still apply. Silver breaking above the $70 level is not a routine price fluctuation driven by speculation or short-term momentum. It represents a structural shift in market dynamics that demands serious economic attention. For years, silver prices were held within ranges that reinforced the belief that supply was abundant and easily responsive to demand changes. That belief is now being challenged. When a commodity with historically deep liquidity crosses such a psychologically and technically significant threshold, it signals that marginal demand is overwhelming the system's ability to respond. This is not noise in the data, it is the market revealing stress. Ask yourself this: if supply were truly flexible, why would price need to move this far, this fast, just to clear the market? From an economic perspective, this breakout reflects a classic demand shock colliding with inelastic short-term supply. Mining output cannot be ramped up overnight, above ground inventories are finite, and recycling flows are insufficient to absorb surging interest. Silver supply curve, especially in the near term, is steep. That means even modest increases in demand can cause outsized price movements. What makes this moment exceptional is that demand is not coming from a single source. Industrial users, investors, and institutions are all stepping in simultaneously, each for different reasons, yet competing for the same physical metal. When diverse demand streams converge, price becomes the only rationing mechanism left. There is also a powerful signaling effect embedded in this breakout. Markets are forward-looking, and prices move not only on current conditions, but on expectations of future scarcity. A sustained move above $70 tells participants that the old equilibrium no longer holds. It forces reassessment of long-term contracts, hedging strategies, and capital allocation models. Producers become cautious sellers, buyers become urgent, and intermediaries begin tightening terms. This feedback loop accelerates price discovery, pulling future expectations into the present. Once that process begins, it rarely reverses smoothly. Here's the hook that many miss. The most dangerous phase of a repricing is not the spike itself, but the disbelief that follows it. When observers dismiss a breakout as temporary, They delay adjustment, allowing imbalances to grow larger beneath the surface. History shows that when a market breaks out after prolonged suppression, it is not announcing the end of a move, it is announcing the beginning of repricing. Silver crossing $70 is the market's way of saying that previous assumptions about abundance, control, and stability are no longer valid. In economics, moments like this separate trend followers from structural thinkers and comfort from foresight. The figure of 517 million ounces held in COMEX vaults appears, at first glance, to signal abundance and stability, but in economic reality, it represents something far more complex and far less reassuring. Inventory statistics in commodity markets are often misunderstood, and silver is a prime example of how headline numbers can create a false sense of security. In the vault does not mean available on demand. A substantial portion of these ounces is already allocated, pledged against existing contracts, or tied to institutional ownership that has no intention of selling at current prices. The inventory exists on balance sheets, but its economic mobility is sharply constrained. This distinction between nominal inventory and effective supply is critical. Markets function not on what theoretically exists, but on what can be delivered at the moment of stress. When prices rise sharply, as silver has, holders of physical metal become increasingly reluctant to part with it. This hoarding behavior is rational. Higher prices signal future scarcity, encouraging owners to delay sales in anticipation of better terms. As a result, reported stockpiles may remain static while actual tradable supply shrinks. This is where the paper market begins to diverge from the physical one, and that divergence carries serious implications. COMEX operates primarily as a futures exchange, not a physical distribution system. The vast majority of contracts are settled financially, relying on confidence rather than delivery. This works smoothly until confidence is tested. The moment a higher than normal percentage of participants demand physical settlement, the system encounters strain. Multiple claims on the same underlying ounces become visible, and leverage that once appeared efficient begins to look fragile. The hook here is simple but uncomfortable. Leverage feels invisible until too many people ask for the same thing at once. Another layer of risk lies in the classification of vault holdings. Categories such as eligible and registered are often conflated, yet only a fraction of total silver stocks are actually designated for delivery against futures contracts. Shifting metal from one category to another is not automatic. It requires consent cost, and oftentimes, in a rapidly tightening market, time becomes the most expensive variable of all. Delays amplify uncertainty, and uncertainty fuels volatility. The deeper economic signal is this: when markets rely on inventory figures that overstate true availability, price becomes the mechanism that exposes the illusion. Rising prices are not irrational, they are corrective. They force a reconciliation between paper claims and physical reality. The belief that hundreds of millions of ounces guarantee stability is comforting, but comfort is not an economic indicator. When confidence erodes, it does so quickly, and the realization spreads that supply was never as accessible as it appeared. In moments like this, numbers stop being reassuring and start being questioned, and that questioning is where true price discovery begins. Silver's role in the global economy has fundamentally changed, and this shift is being underestimated by those who still view it through a purely historical or speculative lens. What was once considered a secondary industrial input has quietly become a strategic material embedded in the infrastructure of modern growth. From solar panels and electric vehicles to advanced electronics and medical applications, silver is no longer optional, it is essential. This transformation has created a demand profile unlike anything seen in previous cycles, where consumption is tied not to discretionary spending, but to long-term policy objectives and technological commitments. When governments and corporations lock in multi-year plans around energy transition and digitization, demand becomes sticky, persistent, and largely insensitive to price in the short term. This is where the economic tension intensifies. Industrial demand for silver is price inelastic because substitution is either technologically difficult or economically inefficient. Manufacturers cannot simply remove silver from photovoltaic cells or high-performance circuits without sacrificing efficiency and reliability. Even as prices rise, production must continue. This creates a baseline level of consumption that does not retreat when markets tighten. At the same time, investment demand is accelerating for entirely different reasons, driven by currency debasement concerns, geopolitical uncertainty, and declining confidence in financial intermediaries. These two demand streams do not cancel each other out, they collide. The hook most people miss is this: industrial users and investors are not just buyers, they are competitors. They are drawing from the same finite pool of physical metal, yet they respond to price signals in opposite ways. Higher prices discourage consumption in most markets, but in silver they can actually intensify demand. Investors interpret rising prices as confirmation of scarcity and systemic risk, while industrial users rush to secure long-term supply to protect production lines. The result is a feedback loop where price increases reinforce demand instead of suppressing it. This dual demand structure alters traditional supply-demand modeling. Silver is no longer behaving like a typical commodity that cycles neatly between surplus and deficit. It is evolving into a hybrid asset, part industrial input and part monetary hedge. In such markets, equilibrium is unstable. Small disruptions, whether from mining delays, regulatory changes, or geopolitical tensions, can produce disproportionate price responses. The system lacks a buffer, and without a meaningful strategic stockpile, pressure accumulates beneath the surface. Economically, this is the kind of environment where markets appear calm until they suddenly are not. The rising price of silver is not just reflecting current consumption, it is pricing future competition for supply. When a metal becomes strategically important to both economic growth and financial preservation, the question is no longer whether demand will remain strong, but whether supply can ever catch up fast enough to restore balance. The modern silver market is built less on the movement of metal and more on the movement of confidence, and nowhere is this more evident than in the futures system. Futures markets were designed to manage risk and provide price discovery, not to serve as large-scale delivery mechanisms. Under normal conditions, this distinction remains invisible because most contracts are settled in cash, rolled forward, or offset before delivery ever becomes relevant. The system works smoothly as long as participants trust that physical settlement is possible, even if it rarely occurs. That trust, however, is the true foundation of the market, and trust is not a fixed variable. When prices begin rising sharply and persistently, incentives change. Participants who once viewed futures as purely financial instruments start reconsidering their assumptions. Industrial users facing supply uncertainty and investors seeking tangible assets begin to ask a dangerous question for a leveraged system: what if I want the metal itself? Even a modest increase in physical delivery requests can expose structural stress because the paper market represents multiples of the underlying physical supply. The hook is uncomfortable but essential to understand. Futures markets are efficient until they are tested, and they are tested precisely when they are needed most. Cash settlement, often presented as a safety valve, can quickly become a point of friction. While it resolves contractual obligations, it does not resolve the underlying issue of physical scarcity. In fact, repeated reliance on cash settlement during periods of rising prices can deepen mistrust. Market participants begin to question whether futures prices truly reflect physical reality or merely the willingness of counterparties to settle financially. Once that doubt takes hold, liquidity can evaporate faster than models predict, as participants demand higher premiums or withdraw altogether. This dynamic introduces systemic risk not through failure, but through behavior. Markets rarely collapse because rules are broken. They destabilize because incentives shift. If enough participants simultaneously prefer certainty of ownership over convenience of settlement, leverage that once enhanced liquidity becomes a source of vulnerability. Margin requirements rise, volatility accelerates, and the cost of maintaining paper positions increases. These pressures feed back into price, reinforcing the very move that triggered them. Economically, this is a classic confidence threshold problem. The futures market does not need everyone to demand delivery to experience stress. It only needs enough people to challenge the assumption that delivery is unnecessary. Once that threshold is crossed, even briefly, the system must adjust through price, policy, or structure. In such moments, silver ceases to be just a contract or a quote on a screen. It becomes a test of whether financial promises can still substitute for physical reality. And history suggests that when this test emerges, the adjustment is rarely subtle. Silver's recent price behavior cannot be separated from the broader monetary environment in which it is unfolding. Periods of aggressive monetary expansion, rising sovereign debt, and persistent fiscal deficits gradually reshape investor psychology. Trust in Fiat-based instruments does not disappear overnight. It erodes quietly, almost invisibly, until markets begin to price that erosion in real time. Silver's ascent reflects this shift. It is not merely reacting to industrial demand or supply constraints, but to a deeper reassessment of monetary credibility. When purchasing power feels uncertain in policy responses, appear reactive rather than strategic, capital seeks anchors that exist outside the financial system. From an economic standpoint, silver functions as a hedge against counterparty risk, a feature that becomes increasingly valuable during periods of financial stress. Unlike bonds, currencies, or complex derivatives, physical silver carries no promise dependent on another party's solvency. This attribute becomes more attractive as interest rates struggle to compensate for inflation risk and as real yields remain compressed or negative. Investors are not abandoning fiat instruments out of ideology. They are reallocating based on risk-adjusted expectations. The hook here is subtle but powerful. Markets do not need a crisis to lose confidence. They only need inconsistency. What amplifies this trend is the perception that monetary authorities are constrained. High debt levels limit policy flexibility, while political pressures discourage austerity. In such environments, inflation is often treated as a tolerable outcome rather than a threat, and currency debasement becomes an implicit tool. Silver, historically sensitive to these conditions, responds not to official statements but to cumulative behavior. Each expansionary policy, each emergency liquidity measure, reinforces the idea that fiat stability is conditional, not guaranteed, over time. This realization shifts capital flows in ways that appear gradual until they suddenly are not. Another important dimension is accessibility. Silver occupies a unique position between gold and financial assets. It is tangible, divisible, and historically monetary, yet priced low enough to attract a broad spectrum of participants. As confidence weakens, this accessibility accelerates demand, turning silver into a pressure valve for monetary anxiety. Rising prices then serve as confirmation, not deterrence, validating the decision to rotate into hard assets. This creates a reflexive loop where declining trust feeds higher prices, and higher prices feed further scrutiny of fiat systems. Economically, this environment favors assets that exist outside policy control. Silver's rise is not an indictment of fiat currencies in isolation, but a signal that markets are rebalancing probabilities. They are assigning greater weight to scenarios where monetary discipline remains elusive. When that happens, price becomes a language of trust or lack thereof. Silver's message is not alarmist, it is analytical. It reflects a rational response to long-term monetary dilution and the quiet recognition that scarcity, not promises, ultimately anchors value. The widening gap between physical silver fundamentals and paper-based pricing mechanisms is a hallmark of markets transitioning from control to discovery. For extended periods, prices can be restrained by financial structures that prioritize liquidity, leverage, and confidence over immediate physical constraints. This creates an illusion of stability where volatility is suppressed and price movements appear orderly. However, when underlying fundamentals strengthen while suppression mechanisms remain unchanged, tension accumulates beneath the surface. The market does not release that tension gradually. It waits, and then it adjusts abruptly. The hook to understand here is simple but unsettling. The quieter a market appears during suppression, the louder the repricing tends to be. Economically, this process reflects a breakdown in the signaling function of prices. When paper instruments dominate trade volume, price becomes increasingly detached from physical supply and demand. Yet this detachment is temporary by nature. Physical constraints always reassert themselves because they are governed by reality rather than confidence. As silver demand grows across industrial and investment channels, the paper market must either adapt or be overridden. The widening spread between futures pricing, premiums on physical metal, and delivery timelines is not an anomaly. It is evidence that the market is searching for a new equilibrium. Volatility in this phase is not a malfunction, it is a mechanism. Rapid price movements force market participants to reassess assumptions, unwind leverage, and reprice risk. Models built on historical correlations begin to fail because the regime itself has changed. What once looked like excess becomes necessity, and what was once dismissed as speculative behavior becomes defensive positioning. This is why repricing events feel chaotic in real time. They are compressions of years of misalignment into short periods of adjustment. The most dangerous mistake during such transitions is linear thinking. Many assume prices will revert simply because they always have in the past. But markets do not revert to history, they respond to conditions. When physical scarcity, Monetary uncertainty and leverage converge, the resulting price discovery can overshoot in both directions before stabilizing. This is not irrational exuberance. It is uncertainty being priced under pressure. The deeper implication is that silver is moving from a managed market structure toward a more transparent valuation process. As leverage declines and physical realities take precedence, price becomes less predictable, but more honest. Participants who understand this dynamic do not fear volatility. They recognize it as the cost of truth emerging. In such environments, stability is not found in calm prices, but in assets whose value is determined by scarcity and utility, rather than by confidence in paper systems that are increasingly being tested. So here is the real question you should be asking yourself tonight. Are you positioned for stability, or are you positioned for comfort? Because comfort comes from believing tomorrow will look like yesterday, while stability comes from understanding structural shifts before they become headlines. Silver's move is not about hype, it is about trust, supply, and reality colliding. The market is sending a clear message to those willing to listen. When price breaks key levels and physical metal stays locked behind vault doors, the future doesn't whisper anymore. It speaks loudly. And those who recognize the signal early are not reacting in fear, they are moving with clarity, confidence, and purpose. Thank you